Good afternoon, everyone. Today is a practical follow-up to the previous theoretical video where an attempt was made to quantify the required level of improvement to each of the four key components of the P&L to make a losing strategy break even or go profitable. The four components are the number of profits, the number of losses, the average size of profits, and the average size of losses. Based on the final summary of possible improvement options, the choice fell on first addressing the average profit size, and hence the take-profit part of the algorithm. This was tested on the flat market tortoise strategy, which had briefly returned from its training to share what it's learned so far. In addition to what will be covered in just a minute, a more careful selection of coins was made for the algorithms, and the distance of 0.65% was abandoned completely. Now to the take profit. Most of the algos used so far had a fixed take profit of 0.2%, especially at lower distances, which seemed like a reasonable industry standard, low enough to be more likely to catch even the smaller rollbacks, but high enough to cover the fees paid to the exchange while still remaining interesting in terms of the trader's profits. With a view to increase the average profit per trade, rather than trying out various levels of take profit at each distance, a more radical and comprehensive approach was taken using the auto price down option. A quick reminder, when enabled, this option sets the take profit at this percentage, then every specified number of seconds lowers it by the size of the step until it reaches the limit specified here, where it remains until the position is closed by any means. On the graph, it looks like this, like a staircase. What's radical about the new approach is that there are no staircases involved. It just takes too long. Instead, we have this. Set the take profit very high, equal to the distance in this case, trying to take as much as possible. And then, if it doesn't close immediately, throw it to 0.2% from the opening price in one huge step within the first half of a second. Here are a few examples. The take profit was set at the very base of the shot. It did not roll back to that level, so after half a second, it went straight to 0.2% where it closed successfully. A slower staircase approach wouldn't have worked, because the position would have closed at a stop loss before the take profit and the price could meet. A similar example here. The take profit was thrown towards the price just soon enough to not let it get away, and the staircase wouldn't have been successful. In both of these cases, the result is the same as the traditional 0.2 take profit. These are used to illustrate that a fixed take profit at a higher level, say 0.3%, wouldn't have worked specifically here. Now, where is the benefit of this approach? Here are a few more examples. Here, at the distance of 0.95, the take profit was set at the base of the shot, and then, on its way down towards 0.2, it met the price at 0.37 and closed the position there, almost double the usual fixed take. Similar story here. The take profit took as much as was available in the first half a second, which was 0.41%. Here's more. 0.7 take out of 0.95. 0.6 take out of 0.95. And here is the craziest one. 2 trades, same algo, same coin, 1 loss, 1 profit. But the loss is at minus 0.35%, while the profit is at the full plus 0.95%. Of course, there are circumstances where it doesn't help. No rollback, no take of any kind. At this time, there aren't any available examples of where a traditional fixed take profit of 0.2 would have definitely fared better, although they definitely exist. There is a catch to all of this. When order price down engages and tries to place a limit order at 0.2% from the opening price, while the price at the time in fact is better than that, your limit order gets thrown into the opposite side of the order book and closes at the current market price, thus triggering the taker fee rate instead of the maker fee rate. As long as the extra take covers the difference in fee rates, it is still worth it. Here is how it worked out so far in practice. For the updated tortoise strategy, mainly two distances were used, 0.95 and 1.55. The aggressive take profit was set at 0.95 and 1% respectively, with a drop to 0.2 after half a second. So far, it yielded plus 97 USDT in profits for an ROE of 15%. The profit-to-loss ratio is only 2.12, but the break-even ratio is even better at 1.88. And based on the math in a previous video, this equals overall profit. The real average profit, post-fees, across both distances was 0.3%. At 0.95, it was 0.29%, so on average, the strategy at this distance took about 1/3 of the overall distance of the shot. For the distance of 1.55, the average profit was 0.33. Also, check out the median. Isolating only the profits, it says that half of the 227 takes were greater than 0.33%. Let's compare like for like with the previous incarnation of the tortoise, using only the same distances. The average loss is slightly better for the new version, and the average profit is slightly higher. The profit-to-loss ratio is way down from 1 in 3 to 1 in 2. But the break-even ratio has improved from 2.33 to 1.88 due to slightly higher takes and slightly lower losses. So, with these seemingly minor tweaks, the ROE shot up from 2.2% all the way to 15%. There's still room for further tweaks, such as how aggressive the initial take profit should be in relation to the distance, and how fast the order price down should engage. Even 1/10 of a second may potentially make a difference. Also, one might explore the timing relationship between the speed of the order price down and the stop-loss delay. Of course, one should never forget about the front end of the trade, but the adjustments to the back end of the trade are proving themselves quite well so far. If you want, subscribe.